May 2019. British Steel enters compulsory liquidation. Around 5,000 direct jobs at risk. Another 20,000 across the supply chain. A company that once built Britain's railways, bridges, and warships collapses overnight. This wasn't a sudden failure, no fraud, no single bad decision. Just the slow suffocation of an industry caught between global markets, political indecision, and financial engineering. This is the story of how British steel became unviable in its own country. Steel built modern Britain. It built railways, bridges, warships, and infrastructure that lasted generations. For decades, steelmaking was treated as a strategic national asset. The industry was nationalised in 1967, resulting in the creation of the British Steel Corporation. By the 1990s, it employed over 50,000 people. Then came privatisation. British Steel merged with Dutch firm Hoogevens in 1999 to form Chorus. In 2007, Chorus was acquired by India's Tata Steel for £6.2 billion. Ownership changed. Markets shifted. But one thing remained constant. Britain needed steel. Virgin steel, produced from raw materials in blast furnaces, is essential for major construction projects. It has fewer imperfections than recycled steel. Without it, Britain would depend entirely on imports for critical infrastructure. Yet despite steel's strategic importance, successive governments treated it as a commercial afterthought. No long-term industry strategy nor coordinated support. Just reactive politics when crises emerged. Britain wanted steel without wanting to support the steel industry. What emerged was a brutal economic reality. In 2016, Tata Steel's UK operations were struggling. High energy costs, pension liabilities, competition from cheap imports. Tata decided to sell its Long Products division, which made steel sections for construction and railway tracks. The business was losing money. Buyers were scarce. Private equity firm Grable Capital stepped in. It bought the division for £1 in April 2016 and renamed it British Steel. The deal was politically urgent. Thousands of jobs were at stake, mostly in Scunthorpe, Lincolnshire. The government supported the sale. Workers were relieved. But the company was reborn, already fragile. Grable specialised in distressed businesses. Its track record was mixed. It had backed Monarch Airlines, which collapsed in 2017, and Comet Electronics, which failed in 2012. The buyout structure was highly leveraged. British Steel was loaded with debt from the start. Grable charged the company substantial management fees and interest on loans it provided. In 2017, British Steel owed its Journey-based parent company £154 million in secured loans. The interest rate was 9% plus the LIBOR rate. That meant annual interest payments of around £17 million. Cash extraction on this scale constrained the company's ability to invest. The debt burden meant British Steel had almost no financial cushion. One bad year could be fatal. To understand why the margin for error was so slim, one must look at the mounting pressures of some factors. Steel margins are thin. A 1 to 4% operating margin is typical. Small cost disadvantages become fatal. British Steel faced higher costs than most European competitors. Energy was the biggest problem. UK steelmakers paid some of the highest electricity prices in Europe. According to industry group UK Steel, British producers paid 86% more for energy than their German counterparts, and 62% more than French steelmakers. These costs were driven by environmental levies and policies aimed at reducing carbon emissions. The goals were laudable, but they made British Steel uncompetitive. Carbon pricing added further pressure. Under the EU emissions trading system, companies received free carbon credits based on their emissions targets. If they performed well and emitted less, they could sell excess credits. British Steel did exactly that. Between 2013 and 2018, the company sold its surplus carbon credits, expecting Britain to leave the EU by March 2019. Then, Brexit was delayed. Britain remained in the EU emissions scheme. British Steel faced a massive shortfall. It needed to buy back credits or face a fine of up to £630 million. The government eventually provided a £120 million loan to cover the payments. But the crisis revealed just how fragile the company's finances were. British Steel was also burdened by legacy pension liabilities. While Tata had safeguarded most pension rights before the sale, smaller schemes remained with deficits totaling £46 million. Add it all up: high energy costs, carbon payments, debt servicing, pension obligations. British Steel was operating on a tightrope with no safety net. But while the company struggled to maintain its balance, a massive storm was gathering across the horizon. Steel is a global commodity. Prices are set by global supply and demand. British Steel didn't escape those forces. By the late 2010s, global steel markets were flooded. China was producing over half the world's steel, more than 1,000 million tons annually. Britain produced around 5.6 million tons. Chinese overproduction drove prices down. Steelmakers worldwide struggled. Accusations of dumping, selling steel below production cost to capture market share, became common. The European Union imposed anti-dumping measures on Chinese steel in 2017 and extended them in 2018. Safeguard tariffs were introduced to protect European producers. But these measures were insufficient. Cheap steel continued to flow into European markets from other countries, including Turkey and India. British Steel exported around 70% of its products. Key markets included the EU, Turkey, and North Africa. When global prices fell, British Steel couldn't raise its own prices without losing customers. Then came US tariffs. In 2018, the Trump administration imposed 25% tariffs on steel imports. The measure was designed to protect American steelmakers. But it redirected steel that would have gone to the US toward European markets, further depressing prices. Britain faced a dilemma. Its political rhetoric favored free trade, but its steel industry needed protection from global overcapacity. The government never resolved this tension. Britain wanted open markets and a domestic steel industry simultaneously. The two goals were incompatible. As the country struggled to reconcile these aims, it fell into a strategic vacuum. Brexit created a fog of uncertainty that paralyzed decision-making. British Steel's customers didn't know what trade regime would apply after Britain left the EU. Would there be tariffs, regulatory barriers, or customs delays? In the absence of clarity, many delayed orders. Why commit to a British supplier when the terms of trade might change overnight? Currency volatility added to the chaos. The pound's value swung wildly after the 2016 referendum. This made long-term contracts difficult to price. Investment decisions stalled. British Steel couldn't plan capital expenditure without knowing what regulatory framework it would operate under. Brexit uncertainty also affected the company's ability to secure financing. Lenders were reluctant to commit to a business facing such profound unknowns. By early 2019, British Steel's order book was thinning. The company told The Guardian that European orders had evaporated due to Brexit uncertainty. In the event of a no-deal Brexit, World Trade Organization tariffs on steel would be 20%. That would make British Steel uncompetitive in European markets almost overnight. Political paralysis compounded the problem. Theresa May's government was consumed by Brexit negotiations. Industrial strategy was an afterthought. The result was drift. No decisions, no support, just mounting pressure on a company already close to breaking point. Eventually, the pressure became too great for the structure to hold, paving the way for the end. By April 2019, British Steel was losing around £1 million per day. The company needed immediate cash to survive. It requested a £75 million emergency loan from the government. The government provided £120 million to cover carbon credits payments, but it refused the additional £75 million. Grable Capital then offered to put up more money, reducing the loan request to £30 million. Still, the government refused. Business Secretary Greg Clark stated that the government could only act within the law, which required financial support to be on commercial terms. He was advised that providing a guarantee or loan on the proposed terms would be unlawful. Critics argued the government had found billions to bail out banks and could have done more for British Steel. Ministers pointed to EU state aid rules, though those rules had not prevented support for other industries. On May 22, 2019, the High Court ordered British Steel into compulsory liquidation. The official receiver, an employee of the Insolvency Service, was appointed to manage the process. The company continued trading while a buyer was sought. The human impact was immediate. Scunthorpe, a town of around 80,000 people, was devastated. The steelworks had been the economic heart of the community for over a century. Workers learned of the collapse from news reports. Suppliers faced catastrophic losses. Many were small businesses that couldn't absorb unpaid invoices. Trade unions condemned the government's inaction. GMB union leader Tim Roach said the government either don't care or wouldn't take off their ideological blinkers to save hard-working people and communities. MPs from affected constituencies pleaded for intervention. Nick Darkin, MP for Scunthorpe, called the news devastating and urged the government to take a public stake in the company if necessary. But by then, the decision was made. The priority shifted from growth and sustainability to a minimalist goal. The government scrambled to contain the damage. Ministers formed a British Steel support group involving management, trade unions, supply chain companies, and local communities. The goal was to pursue every possible step to secure the company's future. EY, appointed as administrators, began searching for buyers. Several parties expressed interest. Negotiations dragged on for months. In March 2020, Chinese steelmaker Xinye Group completed the purchase of British Steel for around £50 million. The deal saved most jobs. Production continued. But the structural problems remained. British Steel was still operating in the same high-cost environment. Energy prices hadn't fallen. Global overcapacity hadn't disappeared. Brexit uncertainty was replaced by Brexit reality, with new trade barriers and regulatory divergence. Xinye invested in the business, but by 2025, the company was again losing money. It was reportedly losing £700,000 per day. In April 2025, the UK government took emergency control of the Scunthorpe plant to prevent its closure. It used special legislation to order raw materials and direct the workforce, ensuring blast furnaces continued operating. The plant remains government-controlled as of mid-2025. Public ownership is now considered the likely option. British Steel survived. British Steel policy did not. In the wake of this policy failure, the government is finally being forced to learn. The collapse of British Steel exposed fundamental contradictions in Britain's approach to strategic industries. The first lesson is about alignment. Britain needed steel but refused to create conditions for viable steelmaking. It wanted the industry without the policy framework to sustain it. The second lesson is about cost competitiveness. High energy prices, environmental levies, and pension liabilities placed British steelmakers at a structural disadvantage. Without offsetting support, the industry couldn't operate. The third lesson is about globalization. Free trade benefits consumers. But when global markets are distorted by overcapacity and dumping, domestic industries need protection or support. Britain provided neither consistently. The fourth lesson is about debt-fueled rescues. Grayble's purchase saved jobs in 2016, but loading the company with debt merely delayed failure. Short-term fixes don't address long-term problems. The fifth lesson is about political decision-making. Brexit uncertainty paralyzed the industry. Governments absorbed by constitutional crises cannot manage industrial strategy. Other countries approached these challenges differently. France, Germany, and Italy provided state support for their steel industries. They coordinated energy pricing policies. They protected strategic capacity. Britain did not. The result was predictable. This isn't about nationalization versus privatization. It's about alignment between policy and reality. If steel is strategically important, policy must reflect that. If it isn't, the pretense should stop. Britain tried to have it both ways. The outcome was failure.